Hey there, and welcome back to Just Shelf Digest, your go-to audio pit stop for decoding the world of investing, markets, and smart money moves. I'm your host, and today, buckle up, because we're diving into something incredibly relevant, where investors are finding opportunities and facing risks in 2025 across 10 major asset classes. Whether you're trading crypto, exploring ETFs, or just parking your cash in T-bills, this episode will give you a roadmap for navigating this year's complex financial ecosystem, with insights directly connected across global markets. Let's kick this off. Segment 1: Bonds and Interest Rate Risk. Before we dive into the flashier stuff like crypto and AI tokens, let's set the foundation. Bonds. When you buy or sell bonds, remember, interest rate risk and credit risk are your constant companions. As rates rise, bond prices fall, and longer-term bonds get hit the hardest. So if you're holding a 10-year bond and rates jump, your bond price drops faster than short-term ones. Always weigh both creditworthiness and duration before you buy. Segment 2: Cryptocurrencies. AI meets institutional money. Crypto. It never leaves the spotlight. But 2025 has brought something new: institutional legitimacy. Big players are moving in, fueled by the approval of spot Bitcoin ETFs in the US. We're talking about over $50 billion in assets under management by Q3 2025. That's not just a number, it's a statement. It cements Bitcoin's role as a legitimate institutional asset and boosts liquidity across the market. Now, what are the top trends of 2025? Institutional adoption. Bitcoin and Ethereum ETFs are opening doors for major financial entities. AI integrated cryptocurrencies. Projects combining AI, machine learning, and decentralized data verification are booming. Tokenization. More assets are being represented digitally, unlocking global investment access. And of course, the advantages that make crypto so addictive: 24/7 markets, big volatility, which means opportunity, and lower entry barriers compared to traditional trading. But, and this is a big but, crypto remains highly volatile. Effective risk management is everything. Stop losses, diversification, and never betting more than you can lose are key survival rules in this world. Segment 3: International Equities, the world beyond Wall Street. While US stocks keep getting pricier and more concentrated around mega-cap names, many traders in 2025 are looking abroad. In the first half of this year alone, global equity ETFs saw over $509 billion in inflows, showing a strong investor shift towards international exposure. Here's where investors are focusing: Japan. Corporate governance reforms and inflation comeback make it exciting again. Europe. Strong cyclical rebound potential and more attractive valuations than the US. Emerging markets. Exposure to faster-growing economies. Think Asian tech and Latin American commodities. The advantages? Better relative value, diversification beyond the US, and the demographic tailwinds driving growth. Of course, there are risks: political instability, foreign exchange swings, and changing regulations. Diversify wisely across both regions and industries. Segment 4: ETFs, the Smart Investor's Toolkit. ETFs are everywhere in 2025. The global ETF industry has ballooned to between $14 and $17 trillion in assets. That's a lot of passive investing power. The hottest ETF trends this year include thematic ETFs covering cybersecurity, longevity innovation, and next-gen energy. Sector-specific ETFs for recovery plays like industrials and financials. Commodity and bond ETFs for resource and fixed income strategies. International ETFs to capture foreign markets. Their benefits are clear: instant diversification, lower fees, transparent holdings, and intraday trading. But do your homework. Check the expense ratio and underlying holdings. Some niche ETFs cost more or trade thinly. Segment 5: US value and small cap stocks. Now, let's talk about what's flying under the radar in the US. value, and small cap stocks. While big tech names still dominate, smaller and cheaper companies are drawing investor attention again. Here's why. Money rotation. Investors are moving away from pricey mega caps into undervalued sectors. Interest rate shifts. Smaller firms are more sensitive to rate movement, so they can outperform when rates flatten. Attractive valuations. These indexes are trading at multi-year discounts. They're riskier, yes, more volatile, but with proper analysis, they offer serious upside. Segment 6. Energy and infrastructure, the AI power surge. Energy trading is entering a fascinating dual phase. On one side, geopolitical uncertainty is lifting demand for traditional energy like oil and gas. On the other, the rise of AI infrastructure is fueling a massive need for electricity. In 2024, Brent crude averaged around $80 a barrel, and that momentum continues into 2025. Key sectors to watch: power infrastructure and utilities. Data centers need 5 to 7 times more electricity in the next few years. Oil and gas. Supply challenges and geopolitics still drive volatility and set a price floor. Industrial metals, supporting global infrastructure expansion. Commodities bring inflation protection and structural demand, but remain vulnerable to shocks like weather or political disruptions. Segment 7. Gold and precious metals, the safe haven. When uncertainty hits, gold shines, literally. In early 2025, gold prices reached record highs as investors hunted for protection against inflation and global instability. Silver, too, is benefiting from industrial use, especially in renewables. Why investors hold precious metals? Hedge against geopolitical risk and market turbulence. Inflation protection and diversification. Stable long-term value stores. Central bank demand remains strong. For anyone feeling anxious about financial volatility, a touch of gold in your portfolio can act as powerful insurance. Segment 8. Short-term Treasury bills and cash alternatives. Here's the secret hero of 2025 investing: cash. Yep, old-fashioned liquidity has made a comeback. With 3-month Treasury bills yielding around 3.8 to 4.0%, many traders are using short-term debt as a safe parking spot for funds while scouting bigger opportunities. The upside? Maximum safety and liquidity. Ideal for capital preservation. Strong yields with minimal risk. As rates slowly decline, though, investors will need to weigh when it's time to leave cash for higher return assets again. Segment 9. Real estate investment trusts. Despite trouble in some commercial sectors, REITs in 2025 are thriving in the right niches. Even after a few headwinds, the FTSE Narrowed All Equity REITs Index rose almost 5% in 2024. This year, the spotlight is on data center REITs, riding the AI and cloud boom. Residential REITs benefiting from housing shortages. Healthcare REITs, driven by aging demographics. Logistics REITs, supported by booming e-commerce. REITs give you liquidity, steady dividends, and diversification by property type, but they are interest rate sensitive, so picking the right niche matters greatly. Segment 10. Risk management, your shield and strategy. No matter what you trade, risk management is your lifeline. At the heart of every strong portfolio are 3 pillars: diversification across asset classes to reduce correlation, position sizing to avoid overexposure, and stop-loss orders to control downside losses. And of course, regular portfolio rebalancing to maintain your target mix. Risk management isn't about avoiding losses, it's about staying in the game long enough to win. Closing thoughts. The key takeaway from today's episode: 2025 is the year of diversified opportunity. Crypto, international equities, ETFs, energy, REITs, and even cash all have a role to play. The secret isn't chasing trends, but balancing them. Strategic diversification, disciplined risk management, and a clear understanding of macro trends is what separates excitement from success. Thanks for tuning in to Just Shelf Digest. If this episode helped you rethink your 2025 strategy, subscribe, rate the show, and share it with a friend who loves financial insights. Until next time, stay informed, stay strategic, and keep your money working smarter.